Welcome to the 5th edition of the Genghis Weekly Investor Briefing. In this briefing, we give you a highlight of what has been happening in the past week in the financial markets and what is to happen this week, coupled up with recommendations on both the fixed income and the equity side. This week, we've added another section, that is the derivatives, where we have a new panelist on board, and today's panelists include Churchill Ogutu, who is our head of research at Genghis Capital, and David Micheke, who is an equities trader at Genghis Capital. He'll be the one dealing with derivatives later on in the presentation. My name is Daniel Ogeto. I am from the marketing and communications department, and I therefore now hand it over to Churchill to take us through the equities and fixed income part. Thank you.
Thank you, Dan, for that introduction. Let me share my screen. Welcome to this week's Genghis Weekly Investor Briefing. I'll start with the macroeconomic commentary, and then I go to equities, and then finalize with the fixed income segment. Primarily, this presentation will be our weekly report that we put out today morning. It went out at 6 a.m. Also, there was a topical note that we published on Friday, and that's based on the draft budget review outlook paper. And also, finally, the September primary bond option note that also went out today with the weekly. So with my commentary bits, I'll start with the draft budget review outlook paper. Just to bring you all on board, perhaps some of you think that the budget is a one-day affair where you see the Treasury CS going with the briefcase and presenting to Parliament, and that's the end of it. But perhaps if you think about it, if you think it that way, you can raise your hands, but we can't see you. You're anonymous at the moment. Anyway, the budget process, it starts at a time like this with the budget review outlook paper. So that document was published last week, and it's looking at what was the performance in the last financial year. The last financial year ended in June, and now we are in the new financial year. And this budget review outlook paper is trying to start the budget process for the next financial year, which will start July 1st, 2021, all the way to June 30th, 2022. And in it, it also reviews even the current financial year, how are we performing? And that's based on the performance of the last financial year. So just a look at my slide is what was approved in the budget for the current financial year. In terms of ordinary revenue, that was at 1.63 trillion. And we have the draft budget review outlook paper, I'll call it DROP in short, revised it lower by 110.3 billion shillings to 1.52 trillion. So in essence, based on the underperformance in revenues, tax revenue collections in the last financial year, they deemed it fit to review it lower by another 110 billion to where we are. And what caught our eyes is income tax was the only tax stream that was revised upwards by 14 billion, thereabouts, to 699 billion. But the rest of the other tax streams, we saw downward revisions, with the exception of investment income, which was retained at 28.6 billion. So ordinarily, if you find that if ordinary revenue or revenue that you are receiving is reviewed lower, you could expect even the spending, what the government spends, be it paying wages, be it in operations and maintenance, any other kind of spending should also be reviewed lower, but that didn't happen. So what we have, because of that, whereby we have a reduction in revenue and there's no revision in the spending, we find that now the financing goes up. It's logically, that's the logical result of that. And that also played out. Overall, the net financing in the current financial year has been increased by another 110.3 billion. So that's where we are with the draft prop, whereby our net foreign financing will be up from 347 billion thereabout to 397 billion. That's an increase of 50 billion. And then net domestic financing has been increased by 60.3 billion to 554.6 billion. Fiscal deficit, this is basically that net financing as a percentage of GDP has gone up as implied by this report from 7.5%, what was approved in the budget, to 8.4%. So obviously we are charting an unsustainable path whereby we are borrowing more as opposed to borrowing less, and also the fiscal deficit or fiscal consolidation has been thrown out of the window. Now, I'm getting into the equity segment. Just a recap of last week. Both the NASI and the NSE 20 share were up 1.2% and 1.1% respectively over the course of last week. Turnover, however, declined by 18% to 2.42 billion, and we saw foreign participation around 76% of the overall turnover, and having net inflows of around 216 million. Inflows was on Safaricom. This like the fourth straight week we have been seeing increased inflows into Safaricom, whereas outflows was on Equity, KCB. Those are the two banks, EABL and Bambori, where foreigners exited over the course of last week. And just a look at where the NSE 20 squares up against its African peers. Just a look at some of the metrics that you are keeping an eye on in terms of year-to-date performance. Our Kenyan Nairobi NSE All Share Index has declined by 16.6% against the average of 13.6% that you've seen other markets declining over the course of this year. Market price to earnings ratio, this is another metric whereby even for investors or foreign investors where they are sitting at, they can also see whether the Kenyan market is quite cheap. And right now, or rather as at the end of last week, it was 9.4 times, and the average for the African markets was 13 times. So basically means that how you look at it, you compare the average of a region. So that's the African average is 13, Kenyan is 9.4. So that tells us it's a bit cheap from where anybody who's doing a comparative analysis on the African markets. In terms of dividend yield, so basically this is the percentage of the dividends that is paid out as a percentage of the price of the index. So that is 5.2%, the Kenyan, vis-a-vis an average of 4.5%. So at least the Kenyan market is paying a higher component of dividends as compared to the African peers. So those are some of the sticky points from where foreign investors are looking at the Kenyan market. Getting on to the book closure date. So basically, some of the companies who have announced either interim dividend or the final dividend. So the last date for investors who want to get those dividends, that's the book closure dates simply. So Jubilee Insurance announced an interim dividend of 1 shilling. That book closure was last Friday. Centum final dividend 1 shilling 20 cents. It will be 2nd of October. Kenya Re 10 cents final dividend. 9th of October book closure date, and Kenyan 25 cents final dividend. Book closure still next month on the 22nd of October. Getting on to the trading ideas for the week. Primarily or generally, we are biased towards those counters that have strong buffers strong buffers. Right now, we're still not yet out of the woods in regards to COVID-19 pandemic. So we are more keenly recommending those stocks that have buffers to weather this storm, COVID-19. This week we are recommending a long-term buy on Jubilee Holdings. Historically, it has been having a steady financial performance. If you compare it against its peers, Britam and CAC, some of the key insurance picks. It also has a price to book ratio. This is also another metric that you keep an eye on. It's also on the final page of the weekly that you put out. Now that the Genghis fundamentals. A rule of thumb is that you just look at the average for that sector, and anything below the average for that sector is considered a cheap stock. So it has an attractive price to book ratio at 0.5 times. If you compare with its peers, Britam and CAC are at 0.8 times. And the sector is at 0.65 times. So Jubilee is still attractive at on that metric. And it has also announced the interim dividend. That was the interim dividend 1 shillings per share, which was book closure was last Friday. And that has been against the market trend, not only in the insurance sector, but also across the banking sector, whereby based on the half-year earnings that were released over the course of the month of August, apart from Jubilee, we don't think that there was any other stock in those two sectors that announced an interim dividend. The other caution, actually, is a caution that you're putting out is on KPLC. It released its financial year ending June 2019. That was delayed pending the approval of the Auditor General. And one of the things that caught our eye from that financials was that the auditor's opinion was missing. That's a key element, at least to get a view from the Auditor General in regards to those financials. So we are just advising clients not to get into speculative buying on KPLC. Let me shift gears and go to the fixed income. Just a review of what happened last week. We saw secondary market T-bonds, that's the activity over the course of last week, went down from a record high of around 32.3 billion the previous week to 21.4 billion. That's over the course of last week. So that was a dip of 34% on a week-on-week basis. Weekly T-bills compared to the prior 3 weeks, at least you saw there was an improved performance rate at 84.1%. That in aggregate terms was 20.2 billion bids that was received by CBK, of which most of that was on the 91-day T-bill segments. And right now, in terms of net domestic borrowing, we are looking at 219.5 billion. Comparing it to the initial target for the current financial year, which was 494 billion, we are looking at around 44.5% performance rate. So in under 2 months, we are at this point. So we can say that Treasury is ahead of the curve in regards to domestic borrowing. That said, we still have that upward revisions by another 60 billion in terms of net domestic borrowing, but we'll see it played out in the next 2 weeks once this BROP document has been approved. Just a commentary about liquidity in the markets. Liquidity basically is how, say, in particularly banks are liquid, and that is a function of even how the T-bills, T-bonds, and even the upcoming T-bonds primary auction will be. And we saw that towards the end of the week, average interbank rate had gone down to around 2.5% thereabout. So that is just an indicator that there's some liquidity in the market. And also CBK, it assesses at any given day how liquid the banking sector is. So on Friday, it was seeking to mop 30 billion, and it received bids around 55.4 billion. So that is also an indicator that the banking sector is quite liquid, and it will be supportive of this week's primary bond auction, which now takes me to the next slide, this week's trade. We remember that CBK announced that this month's bond issue, the primary bond, think IPO in equities, which is similar to what we are having in this month's primary bond sale. It's a reopening of 3 bonds. So the first bond was the second 15-year paper that was issued in 2010. The other bond is the first 15-year paper that was issued in 2020, and the final bond was the first 20-year paper that was issued in 2011. All these bonds, because they are above the tenor at their issuance was above 10 years, they have withholding tax of 10%. So right now, how those 3 bonds closed over the weekend is now the column indicated of implied yields, and our recommended bid range for the FXD2 2010-15 is between 10.4% to 10.5%. For the next paper, which is FXD1 2011-20, is between 11.8 to 11.9%. And finally, FXD1 2020-15 is between 12.575% to 12.7%. So that's it from my 2 segments, now the fixed income and the equities. And mine was just a curtain raiser now that we have David, who will take us through the derivative segments. David, over to you.
Thank you, Churchill. Let me just share my screen. Let me know once you see my screen.
We can see a slide, David.
Okay, good. Okay, thank you everyone for attending. I'll just take you through a brief look at the derivatives market, an overview, and then we can get into questions and answers where I can get deeper into what you want to find out. Just give me a sec. You can see my presentation, yes?
Yes, David, you can see your presentation.
Okay. So let's begin with the obvious question. What is a derivative? So a derivative is a financial security with a value that is reliant upon or derived from an underlying asset or group of assets, basically a benchmark. The derivative itself is a contract between 2 or more parties, and the derivative derives its price from fluctuations of the underlying asset. Think Safaricom in this case. When the spot market Safaricom fluctuates, the derivative itself fluctuates as well. Investors buy or sell derivatives to manage the risk associated with the underlying security, protect against fluctuations in value, or to profit from the market movements. So let's look at specifically what is traded in the Kenyan derivatives market. We have VAT, KCB, Equity, Safaricom, EABL, ABSA, and the NSE 25 share index. So each of them has 4 contracts that expire in quarterly time periods. So for example, we had the one that expired in June, the next one is expiring this week, and the expiry is usually the 3rd Thursday of the expiring month. And then the next one will expire in December, and the next one will expire in March. Now, the main difference between the derivatives market and the spot market is the spot market, you need all the cost upfront. So let's take the example of Safaricom, and we use the December contract. So the initial margin that your broker requires from you to open a contract of Safaricom. And remember, for the counters that are priced below 100 shillings, each contract is worth 1,000 shares. So for the like of EABL and BAT, each contract is worth 100 shares. So let's go back to Safaricom. Say we take both positions in the derivatives and in the spot market. What's the actual difference? So in the derivatives market, you will need 3,700 upfront, which is the initial margin. And then you will need 10% of that, which is the additional margin. So you need about 4,070 bob to open a 1,000 share position in the derivatives market. Assume that the price is at 30. In the spot market, you will need the equivalent of 30,000 to buy 1,000 shares. So that's the first main difference between the spot market and the derivatives market. You need less cash upfront to take a position in the derivatives market. And then the other thing is, even though the contracts are priced in quarterly expiries, you can enter and exit a contract even on the same day, unlike on the spot market where you need to wait for T+3. And then one more addition is that in the derivatives market, each cent move, by cent, I mean, say the price is at 30 bob. If you have one contract in the derivatives market and it moves to 30.01, you've gained 10 shillings if you are buying, or you've lost 10 shillings if you are shorting. So let's just look at the fee structure. The derivatives market costs around 0.14 on the equity index futures, and on the single stock, it costs around 0.17. If you notice, this is probably 10% of what you pay in the typical spot market. And then finally, why trade the derivatives market? We've already talked about the lower upfront costs. It costs you about 4,000 to open 1,000 shares position in the derivatives market versus the spot market. And then the additional benefits that you can profit as the market is dropping. You can be able to short and earn money out of it. And then the final one is it acts as a risk management. So how does it play out in your portfolio? Assume you bought Safaricom shares at 30. You bought 1,000 shares at 30. The market starts dropping, but you don't want to exit your spot market position. You come to the derivatives market, you take a short position as the market corrects. You profit from, say, the 2 shillings, 3 shillings drop, exit the profits from the derivatives market and put it into the spot market and buy more shares if you want to. So that's how you can play the derivatives market with the spot market. Now I'll open it up for questions, and that should help me guide what we talk about.
Thank you very much, David and Churchill, for the wonderful presentation. There are questions that have been posted by our attendees, our viewers. Morris is asking Churchill, I'm thinking of a stock portfolio that includes Jubilee, Centum, Equity, and Safaricom. What is your opinion on this portfolio? And then the second question also is in regards to Centum. What is your opinion on Centum? And the share price has greatly eroded over the last few months and is trading on a discount with a 0.4 profit to book ratio. And then the third question is from Kevin Wabungo, who is asking, this one will be for Micheke. Is the derivative market ideal for long-term investment? Over to you, Churchill.
Thanks. Let me pick the first questions by Maurice Roberts. Just looking at the portfolio, don't know whether it's a hypothetical portfolio, or it's a portfolio that you have, but I'm seeing KCB Equity and Jubilee, so those are the financials. So it's biased towards or skewed towards the financials, and also and together with KCB Equity and Safaricom, so these are the liquid stocks. So I think it mimics even what most of the investments is. So the overall view of that portfolio is that it's mimicking our model momentum portfolio, which is more of the liquid stocks and the heavily traded stocks. Just to comment about Centum, sorry, I may not give an overall opinion about this portfolio. I don't know, unless now we have some separate discussions separately. Just to see at what entry prices you came in. That's a discussion we can have separately. But general view of that is that it's mimicking the heavily traded stocks over the NSE. Opinion about Centum, yes, we share a sentiment that it's heavily discounted. Just looking at its current portfolio, it's biased towards the investment income, and after exiting some of the investments that it had, be it Almasi Beverages, right now, and also it paid out its bond. It had a bond, that bond matured in June this year, so it's now it has deleveraged. So it's the opportunities right now at the moment, because it's skewed towards real estate and other investment income oriented portfolio. So opportunities at the moment is a bit not forthcoming for Centum. So the counter has been discounted. Though, if I may take you back a couple of weeks back, and this is just based on the share buyback that is now being proposed by CMA. That is also another candidate for share buyback, share buyback, just coming from one of its main shareholders, had proposed it at some point. So that is one of the other stocks that we have pinpointed will be a beneficiary of share buyback trading. So let me leave it at this point, Dan. Perhaps David can answer the question about derivative.
Okay.
Over to you, David.
Okay. So I'm seeing a few questions about the derivatives market. Let's just start with Kevin Bongo. Is the derivatives market ideal for long-term investment? So the way it's structured is, since the contracts expire on a quarterly basis, and currently there's no rollover of your contracts. If you're thinking long-term, you're most likely thinking 3 months. Think of the derivatives market more as a hedging tool. You're using it to take advantage of what's going on in the spot market. Since in the spot market, you're not able to short, you can use the derivatives markets to basically make some money as markets correct, and then at the same time, buy back into your initial spot market position. By spot market, I mean our normal equities market. So if you're looking at it as a long-term investor, you're not necessarily thinking more than 3 months. That would be my view on it.
Okay, to add on to that, I think you could maybe explain more on the derivatives market with an example. Like, give an example so that people may also understand how it applies on the market.
Okay. I need to share my screen on this one. Okay. Are you able to see my screen?
Yes, we are.
Okay. So this is an example of a derivatives trade. So now, in order to take up a position of 1,000 shares of Safaricom at 27 in the equities market, you will need 27,000 Kenya shillings. In order to take the same 1,000 shares position in the derivatives market, you will need to purchase at least one contract, say the 2019 September 19th contract. from the previous table, and you will require around 2,934 shillings. That is the initial margin, and an additional 10% of that. So your entire position would be around 3,227 versus in the spot market, you'd need around 27,000 shillings. So do know that in this example, it does not take into account the free margin. So free margin is what is left in your account to continue taking and trading your position. As say losses are happening in your account, the free margin is what will be deducted, and free margin is what will be added into your account on a daily basis. So, and for the equity market, you will need 27,000 to take the illustrated position, while in the derivatives market, to take a contract of a similar number of shares will only require around 3,227. So now say Safcom moves up 1 shilling in the equities market and also goes up in the derivatives market. It is important to note that even though the price in both markets go up, they may not necessarily be identical. This is as a result of the derivatives market pricing being the sum of the spot and the cost of carry. So this would get into a more definition of cost of carry. Our futures contract is the cost incurred on holding positions in the underlying security until the expiry of the security. The cost includes the risk-free rate and includes any dividend payouts from the underlying. It is commonly used to interpret market sentiments for the stock or indices, as a higher value of cost of carry indicate traders are willing to pay more for holding the security. So back to the trade itself. So in the equities market, open price 27, closing price 28. Number of shares that we own, 1,000. You earn 1,000 shillings on your 27,000 shillings invested. In the derivatives market, say the price opened at 28.02 and closed at 29.02. Your one contract holds the equivalent of 1,000 shillings. You will have earned 1,000 shillings on your 3,227.4. So as an absolute return, you're earning more in the derivatives market on a similar move. So let's look at the opposite of that. In the equities market, the price opens at 27 and drops by 1 shilling. Then you still own 1,000 shares, so you've lost a paper loss of 1,000 shillings in your portfolio. While in the derivatives market, it moves down by 1 shilling, you still hold 1,000 shares, you would have lost 1,000 shillings, and this would be an actual loss in your account. Since in the derivatives market, we mark to market. So that means every day your settlement is credited, your account is credited or deducted with the amount of money you've gained or lost for that particular day. In conclusion, the main difference between the two markets is that a client is able to take positions in the derivatives market with less money upfront compared to the equities market. And also the fees are less. In addition, you can enter and exit your position on the same day in the derivatives market, unlike in the spot market. Profits and losses in the equities market are only realized when you sell out of the shares versus what happens in the derivatives market. While in the derivatives market, your losses or profits are realized every day through the process called mark to market. The account is settled on a daily basis. So let me pause here. If you have any more questions on that, I can dig deeper.
David, there are actually more questions coming in.
Okay.
There's actually more interest on the derivatives market.
Sure. Please read them out for me.
Yes, let me just read them out for you. After this, you're going to tackle the questions from the fixed income and the equities side. So okay. Let me just read for you the questions so that you can finish up with them.
Sure.
Francis Kamau is asking,
yes,
on derivatives, you can make money when stock prices are falling. Now that we are rock bottom, how will we make money. And then Milkangari is asking, you are comparing the derivatives market to the stock market. That is the question. And she is asking for confirmation on that.
Yes.
And
Yes.
then
Yes.
Crispin is asking, how liquid is the derivatives market? What is the risk of having dead capital on derivatives with no ability to trade due to illiquidity?
Okay.
And then Milka is also asking, how do you identify a derivatives option if you are a lay person? And then Dennis Rimberia is asking, is there a tax component applied in the derivatives market? And Milkangari is also asking, how do you plug in into the derivatives market?
Okay.
And then please share the risks that are involved in the derivatives market. That is by Bridget Wavinya.
Okay, I will.
Yeah.
So let me start with Francis Kamau's question.
Yes.
So now that the market has hit rock bottom, how will we make money? So Francis, the thing about our current market, if you've been noticing how prices have been fluctuating over the last few weeks, we seem to be hitting resistance levels. Let me take the example of Safaricom. I think we got to a high of around 30.50. Was it last week or the week before that? And then prices started dropping again. So I can't really say we have bottomed out, but in terms of taking advantage of that in the derivatives market, you see, for every cent movement, your account is credited, especially if it's in your favor, is credited with 10 shillings. So you can take advantage of the small moves that we're seeing in the stock market as it is currently ranging. Next question. What is the difference? This is from Mark Carrao. What is the difference between the derivatives market and fractional share trading, with examples of Robinhood trading up in the US that does fractional share trading? So for just if we're looking at them as, how do I put it? If we're looking at them as contracts, for the derivatives, it is structured to work in our country at the moment. For fractional shares, what they're doing is they're giving you the ability to buy into, say, again, let's take the example of Safaricom. It's not on Robinhood, but let's just use Safaricom because we know it. So the typical share of Safaricom is 30 shillings. Let's use that example. A fraction of that would probably be 3 shillings. So it allows you to buy into it without a lot of money. But currently we don't do that in Kenya. So the main difference would just be how it's structured. In what's it called? Fractional shares, you're actually owning shares. In derivatives, you're owning a contract. It doesn't have claim to the actual shares. And Milka Ngari, yes, I am comparing the normal stock market to the derivatives market. Then Ruth, suppose I want to invest in the derivatives market, who will be managing the account, Genghis or me, and how much is the minimum total cost to start off? So what we'll do is, once you sign up and you've submitted your documents, we will give you access to the derivatives market. It trades on the Avento platform. So at the beginning, you will be submitting trades to us, the equity desk, and then from there we'll be executing for you. Once you get comfortable enough, we have the right to give you the ability to trade for yourself. And then it goes very well with Crispin's question: how liquid is the derivatives market? What is the risk of having dead capital or derivatives with no ability to trade due to illiquidity? So at the moment, the derivatives market is driven mainly by retail. We don't yet have a market maker. The NSE is currently working on that, but we don't have a set date. So the benefit of a market maker is that they will buy our sells and they will sell our buys. So we'll be able to exit and enter at any given moment. So at the moment, if you look at the derivatives market, the most active counters are Safaricom, KCB, and Equity. Those are the counters with at least 10 contracts or more currently traded. And you can enter and exit at least on a daily basis on this particular counters. For ABSA, EABL, VAT, and the index, they don't trade too much. So we might take some time before liquidity is created on that. But hopefully, we'll see a market maker coming on board soon. Milka's question again, how do you plug into the derivatives market since the initial startup cost for the derivatives is lower than the stock market? Why is the initial cost lower for derivatives? So let me answer an earlier question that you asked. The minimum that we have as Genghis is around 10,000 shillings. And as you've seen in the table that I presented, the initial margin is around 3,700 for, take the example of Safaricom. The highest one that we presently have is BAT. That will be around 7,300. And then the index itself, the highest I've seen is around 32,000. But for majority of the ones that we trade, which is KCB, can do around 7,100, Equity around 7,200, Safaricom 2,700. So the initial margins are small. So if you want to take contracts in Safaricom, we can do the minimum of 10,000. So it depends on the contracts that you want to trade. Let me just go back to the questions. Please share the risk involved with the derivatives market. Bridget Wavinya. So the risk that we run on the derivatives market, as was brought out, is the idea that you might not be able to exit your position if it's an illiquid counter. So say you're trading BAT. Majority of the people that trade BAT is probably one or two in the entire derivatives market. So you might be stuck in BAT, but the likelihood of being stuck in Safaricom, KCB, and Equity is slim. The other risk that you run is if you can't exit your position, let's use the example of Safaricom. For every shilling move, you will be gaining or losing 1,000 bob per contract. So if you had 10,000 bob in your account and you took 2 contracts of Safaricom, it's taken out about 8,140 from your account. So that means your free margin, the amount of money that you have to sustain the position, is low. So if the market moves 2 shillings against you or shilling against you, you've lost around 2,000 bob. At that point, you will get a margin call from us. The idea of the margin call is that you fund your account or we help you exit the position. So that's part of the reason Genghis exists. Our idea is to help you get into the market, get out of the market. So that's part of the role that we play for you. Thinking of stuff.
Kevin Safari has raised his hand and Ngina Maingi, so I'll let Kevin Safari talk.
Sure.
Kevin, I've unmuted you.
Good morning. Thank you very much. Can you hear me? Good morning.
Yes.
Yes.
Mine is just to appreciate. I think derivatives have been a big mystery for most of us investors, and just to appreciate the presentation. And I think I'll give it a try. Thank you so much.
Okay. Thank you, Kevin.
Okay. Thank you. Ngina Maingi, I've unmuted you. You can ask your question. Ngina? Okay, Willis Mburu. Wallace, sorry.
Hello.
Hello?
Hi.
Yes, I'll just say I appreciate the briefing on especially on derivatives. I've been interested to know and I really appreciate the information. Just seeking a clarification.
Yes.
If I got into a contract and I'd like to exit on finding that I'm losing, is there provision for that?
Yes. So first, when we start with the minimums, we've allowed you to have at least enough that you can survive a drastic move. And then at the same time, Genghis will come in through either our underlying clients or the Genghis account and help you exit your position if you're stuck. So we're sort of playing market maker for our clients when the need arises. But for the most part, we try and match you with the rest of the market.
David Githaiga is asking, do you have a report on the daily contracts traded on the derivatives market, and how liquid is the NSE 25 contract?
So let me just have to answer that with the NSE 25 contract is not that liquid. If you look at the open interest, there is probably 2 or none currently. For the other counters, you can see we tend to have, we get a report from the NSE on a daily basis of the number of contracts that have been traded. And that's also available on the NSE website. So if you head there, you can be able to see on a daily basis how many contracts were traded, how many of them continue being open, how many of them were exited out of. So that's public information on the NSE website.
Okay, thank you about that. Let's cross over to Churchill. George Ndegwa is asking, what is your opinion or recommendation on ABSA? Churchill?
Thanks for that question. I think I answered it at some point, but anyway, I can answer it. We currently have a target price of 11.43 on ABSA. It closed at 9.74 over the last week. I don't know what price it has opened at the moment or what it is currently trading. Initially, ABSA used to be, it used to rank highly amongst our income stocks, but right now we are not quite optimistic. We are not bullish that ABSA will pay a final dividend this year. Just looking at even the provisions that it had for the non-performing loans, it was 3 times what it was last year. That is coming from the first half numbers that we have. And though one of the things that stands out for ABSA is its efficiency levels. Just looking at its cost to income, we are seeing it declining, so it's a plus. But it ranks highly, even in the banking sector report that you put out end of July. It was one of the 6 banking stocks that stood highly for us. So it's something that George can also consider even over the long term as a long term by just looking at the current price levels. There's a question about mineral stocks in Kenya. That's from Austin Otieno. Just to a general commentary about that, any proposals to diversify the sectors in the NSE is welcome, because right now the NSE is skewed heavily towards Safaricom and also the banking sector. So 80% of the sectors are on those 2 sectors. 80% of the market capitalization are on those 2 sectors, the telco and the banking sector. So any proposal to bring on board the other sectors, now this example, the mineral stocks, is welcome. That said, mineral stocks are highly capital intensive, so you find that before they come to list on any exchange, they have exhausted the options that they have, the capital options that they have. So that's why, and right now, Kenya, we are not a highly mineral economy as compared to, say, South Africa or Nigeria. So it will be a long haul for us now to see mineral stocks being listed at the NSA. Perhaps there could be something, there could be some incubator program for mineral stocks at Ibuka program, but at the NSA, it could be a long haul for us to see them being put being listed.
Thank you very much, Churchill. There are actually more questions directed towards you. Safaricom share price has risen since the start of the pandemic. What has driven the gains and what is the outlook? That is from Eric Obok. And then the second one is, can you give a recommendation on income stocks that an investor can get in on? That is from
Thanks, Dan. Let me start with Eric's question about Safaricom. And I remember right after the pandemic, must have been around May, Safaricom hit a low of, I think, 23 thereabout shillings per share. But you started seeing it coming up. Safaricom has been traditionally, historically being bought by foreign investors, and as the cloud of the pandemic started wearing off, we started seeing some robustness, not only in the Kenyan market, but just across the frontier market. So people started relooking these markets, and that is also another function. That is also what has driven the uptick in Safaricom price. In our presentation and also in our report, you said that over the last 4 weeks, we've seen that consistently Safaricom has stopped even the foreign participants in terms of the inflows. And that is also what we see that, okay, right now, somehow the pandemic has now been, the risk that was there initially has more or less faded or has been completely absorbed by the foreign investors. So we're seeing some appetite into the frontier markets, and those are some of the factors that are bringing back foreigners back to the Safaricom and for Safaricom counter, and also propelling it upwards over the course of the last, I would say the last 1 month, not from the start of the pandemic, but in particularly the last 1 month, you've seen some activity on Safaricom counter. Recommendation on income stocks. Right now, prior to COVID-19, we had one of the portfolios that we monitor theoretically, we call it theoretically, we have some national value around it. But we had momentum portfolio, we had income portfolio, and we had value stocks portfolios. But because of the outlook on dividends, particularly because that's primarily where we are in the names to include under the income portfolio, right now we are not actively monitoring it. But as a rule of thumb, our income portfolio segment includes those counters that have a dividend yield. By dividend yield, I mean as a share, as a percentage of the dividends that they are paying out, be it half year, be it the end of the year, as a percentage of the current price. So that dividend yield, at least 8%, makes the cut for the income portfolio. But right now, because of the capital conservatism that you're seeing by most of the stocks, don't have general on part of, and now companies start issuing their dividends, will look back into this recommendation for income stocks. But rule of thumb, 8% minimum dividend yield makes the cut to the income portfolio. Back to you, Dan. I think that should be it.
Yeah, one final question for David Micheke. For those who would like to open a derivative trading account with Genghis, what are the requirements that they should have? Maybe David, you can expound on this so that anyone who would want now to join the derivatives trading can prepare. Over to you, David.
Thank you very much. So our requirements are very simple. We're going to fill a form and we're going to sign an agreement. Let me just give me a second. I want to read them out. So the requirements are for individuals: fill out an account opening form and ensure they're duly signed. This is provided to you by us. So all you need to do is just give Daniel your email and then we'll forward the requirements to you. Attach a clear copy of your individual ID or passport, attach a clear copy of your individual KRA PIN, attach a recent color passport size photo, present original signed document to our offices. So the document that we're signing is a risk agreement that you understand the level of risk that you're taking with this product. And what we recommend to do is have a brief conversation with you, just to understand your level of sophistication in the market, enough to know, are we working with you, taking the trades for you, or are you able to take the trades for yourself? Or do you want weekly sessions where we brainstorm about positions that you can take? So all these options are on the table, and that's why we encourage to have a one-on-one conversation before you sign up. But we can give you the information on email so that you already know what you require.
Okay, thank you very much, Churchill and David, for the presentation today. Now, if you also want to start trading in, or rather equities trading or fixed income, you can, with equities trading, you can download our application called Jikuze, which is available on App Store and Google Play Store, where you can register and actually start buying or selling shares via your mobile phone. For fixed income trading, you can reach out to us through info@genghiscapital.com, where our client relations team will take over and take you through the fixed income buying process, and you can start off that way and become an investor. Thank you very much for tuning in today to this presentation. We hope to see you in the next presentation. Thank you.